Good morning, everybody. It is Friday, June 5th, 2020, and we are entering into the summer months with some good news about coronavirus. Apparently, almost none of the cases of coronavirus are transmitted outdoors. So, if you want to go on a picnic, if you want to go outside to the park, if you want to hang out with somebody, just don't catch a sneeze or a cough with your face, and you should be okay. So, that's the good news. The bad news is that coronavirus cases are expanding in about half the country, about half of the states in the country. Deaths have ticked up, and I'm waiting for end of the week data because I would like to see um, whether or not the uh, number of deaths on the rolling average has changed. Those 5 and 7 day rolling averages are important because we know that there's lags in reporting. So on Mondays, we usually get real low numbers, but then by Tuesday or Wednesday, the numbers go up. So you need to smooth basically week over week. And what we're hoping is that the number of deaths not only plateau, because that seems to have happened, but don't turn back up and rather start to fall more precipitously. And hopefully deaths across the country fall in the way that they did in New York City. So deaths in New York City are down to I believe it was around 50 a day right now. New Jersey, Connecticut, Massachusetts are still having some problems turning over, but it seems like they're going to follow on the way down out east, presuming, again, that there's not an uptick. I'm not optimistic about that, but I'm hopeful. So we will see. We're going to skip the whole vaccine debate today, the antivirals. We should give that more time. There are at least 5 phase 3s starting on vaccines between now and roughly Labor Day. So we should get pretty good preliminary data by the end of the year, I would think. And that's just the 5 candidates that the United States has picked out. There's a few more internationally. So hopefully by the end of the year, we have pretty good data as to whether or not there are vaccines that are A, effective, and I think that they will be, and B, safe. And that's what I worry about because some of the approaches, for example, Moderna's, are not particularly well vetted long term. So, I mean, that's just the easy way of putting that they haven't seen really long-term success or approvals. So, some of the DNA and RNA-based approaches to vaccines, those are newer. And, I have a lot of faith in biotech, as I've told you over and over again. But new and exciting is often dangerous. Think about some of your dating histories. All right. So let's talk about this stock market that is just going berserk. It is a testament to investor sentiment that this is happening. And it is shocking to me that the rally has gone this far, but there are some simple ways to look at it, and we'll look at it, that should also point out to you that the same thin ice that we were on in December, January, is the same thin ice that we're on today. A crack could turn into a straight down plunge into the cold water, and that is something that I'm not really too willing to play with. I don't think that there are real strong underlying fundamentals. In fact, I think they're extremely weak, despite today's unemployment numbers, which showed a little less gloom, not really an uptick, just less gloom, and so the market rallied. I will talk about those unemployment numbers for just a second here. There is an idea that U.S. hiring really rebounded, and that's only partially true. When you look underneath these numbers, and if you're not watching Bloomberg in the morning, my gosh, they had some really, really good guests today. And I think that that is something that, you know, people ought to be aware of. Wow, I didn't see what was on the screen exactly there. In any case, let's stop that. Let's stop that. The unemployment numbers are showing about a 1/8 of people in hospitality are starting to work again, about 1/8. So that would indicate that there is a bit of a pickup. My interpretation is that you're seeing the summer hospitality season get off, you know, and you're seeing that hiring, and certain restaurants and hotels and things like that are adding a few staff, and that's good. However, it doesn't in any way indicate that suddenly the other 7/8 of those people are going to get rehired. So I think that you should take a look at what is really happening in unemployment, where when you hear those drums of, oh, look, it's rebounding. You know, we still have, you know, tens of millions of people without work that are starting to get to the point that that stimulus check is wearing off. You know, presumably they've got their June bills paid, but you know, what happens in July? So that's something that I worry about tremendously, is that there are still tens of millions of people who are going to be short on cash going into July and August. And again, those are people who are no longer contributing to 401k plans. And it means that as they become short on cash, what happens? They have to start cashing in their retirement plans. So I'm worried about that. The unemployment numbers aren't as good as you would be made to believe by the CNBCs of the world. Again, I'm telling you, if you're not watching Bloomberg in the morning instead of CNBC, you're just missing out. The guests on Bloomberg blow away the guests on CNBC, and you don't have to sit there with the editorializing and smart-ass remarks by Joe Kernan, who I just think is one of the biggest knuckleheads out there. So, you know, if you have Roku or you have Amazon Fire, the Bloomberg app is right there for free. If you have a cable package still, you dinosaur, you know, make sure you have the one with Bloomberg. That is far and away the best financial news network out there. They have more of a European style of interview. So it's news, good guest, good guest, good guest. And their data is second to none. And that's really what makes Bloomberg famous. That's why professionals use the Bloomberg terminal, right? They don't just call it a Bloomberg terminal. They call it the Bloomberg terminal. It's like the Ohio State or something. So, you know, take a look at that. That's enough endorsement for them. So let's take a look at where the stock market is, because I think that it's important. So here is a weekly chart of the S&P 500, and what you can see is that we broke through another range of resistance levels, right? On the way down, there's support levels, but on the way up, there are resistance levels. And we're going to get all the way up to these resistance levels imminently. I don't know if they may have already hit in the last, you know, hour. So that 319, 321 region, there's a minor level up here at 327, and then of course all the way back up to the highs. I don't know if this market is trying to get to the highs. Maybe it is. Maybe it thinks it can sniff its way all the way back up there. If it does, then we really have to think hard about, is that a double top? Is it going to be a breakout? What is it? I suspect that we're going to jitterbug in this area for a few days next week, and then the market will make a decision. Could go up to here. It could. You know, it's not rational based on the economic news, but everybody is thinking that the Fed is the big deal. And I will talk about that in just a moment. But let's take a look at some technical indicators, because I want to teach you a little bit about this, because I think it will help the people at Fundamental Trends with their trading and investing. And I think it'll help the people at Margin of Safety investing with their investing. And that's really the basic breakdown between the two services. Margin of Safety investing, really for pre-retirees and retirees. And then the Fundamental Trends adds the trading and the growth. So, you know, they're very similar services. There's just some added things over at Fundamental Trends. And you pay for it. So, relative strength index. On the daily chart, we are once again overbought. What do we know about that? Usually you get a small correction at least. And that would coincide usually with a weekly chart that is also approaching overbought. And we'll get to that in a second. We already know, because we looked at this chart, that the equity put to call ratio is below 0.5, got all the way down to 0.4 yesterday. My guess is that they're blowing out more people today. So you're going to see a equity put to call ratio somewhere with a 0.3 handle, which is like record setting low. Every time that happens, there's generally a correction of some sort. I would like to just point out, and we'll talk about it in a second, here, 2018 meltdown, right? But then there was that intermediate rally, and then the big blow off at the end of the year. So now let's look at that on the weekly chart, right? So RSI on the weekly is approaching extreme overbought, but not there yet. Probably be about 65 after today. But let's think about this. The RSI weekly doesn't always make it to overbought before a correction. What would be a good example of that? Let's take a look at the rally that started really, you know, off the bottoms of 2015 and 2016. Consider this a double bottom, right? I could connect those two lines all the way to the top in January of 2018, when we had that big volatility event that I forecast, and people made hundreds and hundreds % on that VIX trade. Then the market dropped, right? Had a rebound and it was choppy, and then we started getting a really good rally throughout the year, but it never got overbought again, and kablamo, the 2008 meltdown. So look at that and how that manifested, and now look at this one. So here's a couple of things that I would point out. This pattern here, lower lows, lower highs, right? If this doesn't break out, you know, we should really think about, is this bull market going to stay intact? And a couple of other analysts have pointed out that we might be seeing a major head and shoulders topping formation. It's something I mentioned, like, I don't know, it had to be January or February. I said this might be a head. And it's turning out that maybe it was a head, and now we're forming a shoulder. So we will take a look at that as a second as well. But I hope that this just screams out to you that it could be a repeat on a slightly different scale. And look how steep this one is. Whatever could have made this be so steep? Well, let's take a look at money flow index, which is a volume weighted measure of RSI, right? Relative strength index, money flow index. And the money flow index on the daily chart is not overbought, extreme overbought. Remember, the RSI was up near its extreme overbought line, but money flow index is not. What does that indicate? Generally, when things are going up, and RSI and MFI are both going up and approaching overbought, if money flow index is higher than relative strength index, relatively speaking, that means that there's good underlying strength in that market. right? It means that the big people and the little people are buying. But when the money flow index is lower, meaning lower volume relative to, norms, that means that there is underlying weakness to the market, even though there's a rally going on. It means that the big people aren't really buying, that this is a small investor-driven thing. And we have seen other measures of this, particularly the way the options markets are working, and the money market balance is, still at record highs because the rich people, the uber rich, I'm talking, your 8, 9, 10 figure people, are still holding mountains and mountains of cash. And the easy example is Warren Buffett on a record amount of cash. Why is he doing that, right? Why is he trimming into this? And I would venture a guess that Warren Buffett is selling Apple stock right now. And when we get that headline, Katie barred the door. Why would Warren Buffett be selling Apple stock? Very easy. It's liquidity, right? It's at a record high. It's liquid. He said he wouldn't buy it over $200 a share, and now it's pushing the middle 300s. It is an easy thing for him to sell because the market will absorb it right now and give him a price. He could probably buy it back down at 220, 230, which is where I was suggesting to buy it. And then it sniffed and it was there for 1 day, right? 1 day it was there. MFI is weaker on the weekly chart too, right? So whereas relative strength index is up here on their weekly chart, money flow index is not. Look how this works, right? This is probably going to drop. These relationships happen over and over again. If you can't see the patterns in these charts, then you're just unwilling to see patterns, right? You're unwilling to accept it. Things that happen over and over and over again happen over and over and over again. As somebody pointed out that I point out, market doesn't always repeat and history doesn't always repeat, but they both rhyme all the time. Same thing in poker. I see the same thing. The same people make the same mistakes, do the same things over and over again. They have their minor victories, and then they have their major defeats. So what we see here is that the shaken money flow on the daily chart has surged. Why does that matter? Well, let's think about what the shaken money flow is. It is measuring about a 20-day period. I think that's how I have it set. Yeah, 20-day period, which is standard. And it is showing that there's a ton of money coming into the market, but whose money is it? Let's take a look at the longer term period. This is the 20-week period. It's not positive and it's not particularly exciting. And it dipped a little bit here in recent weeks. Why? Somebody was taking profits. This is another indicator that the big investors are not buying into this market. Do we think that the big investors are going to buy after the small investors? If we do, we're dumb, because the big investors don't do that. So we've got a really funny looking MACD chart, right? The huge sell-off here, showing how extreme it can get. And then this huge rally here, showing no signs of turning over. But it is one of those things that make you go, right? So can this go a little higher? Absolutely. It can always go a little higher, but it can also always go a little lower. So the next time we see this market sell off, there are scenarios that can make March look tame. And that is something that you have to wrap your mind around as an investor is, okay, Kirk told me in here that we were on thin ice, plunges. And coronavirus, again, was just the match, right? Coronavirus was the match. And the Fed came in and bailed out the coronavirus. But what if there had been no coronavirus? And what if the economy and all those economic charts that I showed you had just kept turning over, right? What if the Fed had not had an excuse to print trillions of dollars? What then? would they have come in right before an election to prop up the economy? That would have been pretty transparent, right? Here they had an excuse. How high can this go? Well, let's take a look at a longer chart. This is the daily chart. This is the weekly chart. Clearly, it can go much higher. Okay, so this rally could extend and test the highs. Could even go through the highs. I don't think it's a trustworthy thing. So again, if you want to play in this game, which is clearly overextended, just understand what you're getting into. You better have the technical knowledge and the willingness to sell quickly if you're going to play this game. Now, I'll make an analogy to poker here. Mike Carroll, one of the many poker pros that I've read over the years, says something like this. The key to winning at poker is to play with worse players. How's that for breaking it down to be extremely simple? If you're going to trade against the professionals in this market and the day traders who are hooked up in groups, right? Day traders aren't all by themselves. They're in groups, right? They belong to a service, or they get on Reddit and they talk to each other there, and they trade in groups, and they have little herds that run in different directions, and they try to convince other little herds to run in those directions too. And so the big herd starts to run, and then it calls to the next size herds, and then the next size herds. And finally, you get down to little herds and all the individuals. You know what happens then? It's time to change direction, right? Robinhood alerts, Reddit, Wall Street bets. These are real things that are going on right now that influence sudden moves in the market. Why on earth is Hertz, a bankrupt company, the number 5 most bought stock this month on Robinhood? The company's going out of business. Well, not out of business, but they're going to have to go through a bankruptcy that completely wipes out the shares. And yet these people are in there gambling. And I don't think most of them know they're gambling. I just had an interview. I'm telling you, you should read some of my exchanges on Twitter. Some of the things I say to people, which are extremely entertaining to me, I think will be extremely entertaining to you. There's a couple millennials talking about, oh yeah, I got into Hertz and I made 17% in an hour, blah blah blah, and he was basically saying everybody should do it, and I was like, yeah, Hertz is going to zero, and he goes, yeah, but it's not going to zero right now. Right now it's going up. I said, yeah, but Hertz is a stock that in 15 minutes could lose 90%, or you could wake up and it could be 90% lower. He goes, yeah, that's true, but it's going up right now. And I said, well, hey, then you must be a superstar trader. Good for you. He goes, well, I don't know where you get that from, just a couple of tweets. And I said, hey, if you're playing with a bankrupt stock, you're one of 3 things: arrogant, inexperienced, or a superstar trader. There's only 3 options, right? The superstar trader might see an arbitrage opportunity. Okay, you're a superstar, you figured it out. Or you're arrogant and inexperienced. Now, those things aren't all mutually exclusive. You could be a superstar trader and arrogant. I've seen lots of that. You could be inexperienced and arrogant. That usually ends up in just a sea of tears. So there's different variations. I think that most people, and I've got like 3 clients who just keep bugging me about, it's going up, it's going up, it's going up, I'm missing it. I honestly don't know what to say to them. And I think that they're going to probably listen to this, so I'm going to tell them to. I don't know what to say to you. This is an extremely dangerous time, and the risk to investing in this market shouldn't be taken by these particular people. Yet they still think about, I'm missing it. And I worry about them, and I don't know how to get across to them that this is so dangerous. And because I know that none of the three of them are really watching these things or understanding them maybe. And I worry about those emotions, because in one case, the person doesn't need to participate in it. Actually, in two cases, the person doesn't need to participate in these rallies given the risk level. And in the other case, the person could use a little extra money, but I think there will be a less risky opportunity in the future. So it becomes always a measure of risk versus reward. What is the potential reward here? That we get to or slightly past the previous highs, I guess. But what is the risk? The risk is, a 30 to 50% loss, maybe 60%, and it changes your life for the worse. So we just always have to keep that risk management in mind. And if we always think of risk first, nothing bad almost ever happens, right? And if it's something bad happens, it's minor. If we chase, sometimes you go right over a cliff. Sometimes the elevator cable breaks. Sometimes you're on thin ice and you fall through and you freeze. So, sometimes you're on top of a mountain and looking and say, oh, how beautiful, and then there's an avalanche. You just need to manage risk with your money. Buffett talks about it. All the great investors talk about it. It's all about risk management first. And all the new investors that come in make the same mistakes generation after generation, chase. Yeah, there's a lot of validity to trend trading, but what's going on is not trend trading in most cases. It's outright speculation. We don't want to be speculators. So let's talk about three scenarios in the stock market, right? One is that the bull market is intact, or we're in a new bull market, and we'll talk about that. The second is that we're going to retest the stock market lows, barely holding the bull market or confirming a new bear market. And then there's the Armageddon scenario bear market. So bear market versus bull market. This is the long-term uptrend, right? That the stock market hasn't broken below in 12 years. Going on 12 years, 11 years, excuse me. From spring of 2009 to what is turning into early summer of 2020. And you see these corrections that, start to get close to the trend line. And really this trend line is probably bent a little bit different, but, on a linear scale, maybe I should have used a different scale. Because I do know that we've gotten closer on certain measurements, but you see that we just get close to this trend line and we always seem to bounce off, right? And that's what happened here. So we got closer to the trend line here, closer to the trend line in March, and then it rallied with the Fed stimulus. And it seems to be right in getting to my highest box here, which I wish I had known that I was going to go this high, right, 2.5 months ago, and not just go like this. I still believe that there's a path down. I don't know if we follow the orange arrow all the way down into here, but we'll see. I don't think that we go without a correction. But for right now, we really are still in the old bull market, because these corrections, even though this one hit 20%, that's not really the definition of a bear market, right? So if you're on TradingView, I actually made public this chart and I put a little explanation in there. And something to put into your head is that the shortcut definition of a bear market is a 20% drop in the stock market. The real definition is that it breaks the trend up, right? It's just like the definition of recession. Everybody thinks that it's 2 quarters of negative GDP. That's not what it is. A recession is a general slowdown in the economy. So clearly we're in a recession. And in fact, we are probably in a recession that lasts significantly longer than we want it to. We're looking at, the second half of next year before a real genuine recovery starts. And again, based on vaccine, that can start pushing us back towards all the 2019 levels, right? For employment, for GDP, for tax revenues, for all that stuff. So we are still technically in the old bull market as far as I'm concerned. So off of this correction, there's widespread perception that the Federal Reserve is juicing the stock market. And there is rightly, that's probably right in the very short term. But it's probably wrong now, or starting to become wrong. Why is that? Because the Fed's not putting so much juice in anymore. There's been no takers actually for the Federal Reserve to buy corporate bonds issued by a company. So nobody has issued a corporate bond that the Federal Reserve has bought. The bond ETF buying is already tapering off, right? They've already started to taper that. The mortgage-backed security purchases have shrunk from over 100 billion per day in March to under 4.5 billion now, and scheduled to go to 4 billion, and I think next week or the week after. So the support for the markets is already draining, right? And the Fed money has not flowed to the primary dealers for redistribution into the financial system, a la the Bernanke QE. Rather, it's gone to the bond market, directly to the bond market, which is why we bought some bonds. Now, the Fed supporting the bond market has a knock-on effect, and that is that it's limited the cuts in the buybacks. Only about a third of the companies so far are announcing buyback cuts. Goldman Sachs said half at some point, and I'm still saying like 80% at some point. And they've prevented new stock offerings to raise capital for now. And the perfect example there is Boeing, right? Boeing didn't even go to the Fed to issue bonds. They issued their own bonds and never, issued new shares. The easiest thing for Boeing to have done would have been to issue shares rather than take on debt. And probably for the health of the company, it would have been better to issue the shares and just let the share price go down to 10 or whatever. It would have been better for Boeing long-term business-wise to have the share price drop another 50% or 75%, because then the company would have the money but not the debt. Instead, all of these companies are issuing debt. What does that really mean for them? It means that certain companies are starting to take the appearance of countries that will never, ever be able to repay their debts. Ever. Not in 1,000 years. So we have companies out there with no growth. They didn't have growth before this all started. And now they have even more leveraged balance sheets. In general, we're already pretty leveraged if you strip out the top 50 cash-rich companies. Right? We know that it's about 50 companies that have, 3/4 of all the money in corporate America. So the Fed's juice is not quite what we think it is. And here I would point out, I want to bring up this article, and I want you to just read this little section. So these are some pretty interesting people. David Rosenberg was actually on Bloomberg this morning. So here's something to think about. The Fed's balance sheet is at about $7 trillion now. I've shown you that chart where it goes straight up hockey stick style. National debt's at 25 trillion now, right? Unemployment's in the teens. PPP loans might lead to more unemployment soon. They talk about that in another article that I have saved up here. So let's just boil this down to simplicity. All right. If the Fed is the cause of the stock market rally, right, printing about $3 trillion, and the stock market's gone up about $3 trillion. Sometimes things, even though that's not a perfectly reasonable and logical way to analyze that, right? It's not quantitatively 100% honest. It's an easy thing to see. 3 trillion, 3 trillion, right? So Jerome Powell went on 60 Minutes. We talked about this a couple weeks ago and basically begged Congress to borrow more money. Why? It's because of the relationship between the Fed and the Treasury. At some point, the Fed can't do anything because there isn't enough treasuries in the market for it to buy up and turn into, click, click, click. Like he said, we clicked a couple buttons. He said that out loud. We clicked a couple buttons and put money into the system. Can't do it if there's no bonds for them to buy. And the reason they want a big stimulus package is so that will put treasuries into the system for them to in turn buy with phantom money that they can turn into click click digital money that turns into scratch your sign your John Hancock at the bank and turn it into real money. So in order for the Fed to continue doing what they're doing, which is already tapering off dramatically, they need another fiscal stimulus package. This is no corporate bonds being bought by the Fed yet because nobody will issue a corporate bond to the Fed. Now, what's interesting here, right, is per that WSJ article, that Wall Street Journal article, and I've talked about this again a few weeks ago, is that the Fed basically saying that it was going to backstop the the corporate bond market stopped the bloodletting. And even though they've been buying the ETFs, which they're tapering off of, we've seen this big rally up in the corporate bond ETFs. So a couple things here. First off, because nobody has actually issued debt to the Federal Reserve directly, there's money sitting in there for that. So that's a backstop. If the shit hits the fan again, this facility already exists for corporations to go to the Fed. Now, it's about $300 billion, I believe they have that they can put in. That's not a ton of money when it comes to the size of the corporate debt market. So it's a double-digit percentage, but it's not like half or anything. So they could really help certain companies with bailouts. And my guess is that some bailouts might be coming if any of the essential industries are threatened again. So that is a bit of a backstop. However, they're tapering off their ETF purchases. and there's only about 5 to 10% upside left in addition to the coupons that these bond funds pay. So as we get closer to these funds being back to par, you probably start trimming your riskiest one. So I just started trimming HYG, not out of it, but I'm selling it a little bit because it's had a big rebound. Today's a great rebound day, so I strongly recommend that you trim some HYG here, because if the stock market turns down, this is the fund that basically has stock risk, because the Fed really isn't buying any high yield debt other than the fallen angels, and HYG is only a single-digit percentage fallen angels. ANGL, the Van Eck Fallen Angels Fund, is 100%, just about 98% fallen angels. And the Fed is playing in that market. So where the Fed has a direct mandate, not an implied, I'm willing to own Angel, and I'm willing to own LQD, which is the investment grade, which is about half triple B. So where is the Fed playing? The Fed is playing in the BBB market and the fallen angel market. And only certain fallen angels had to be before a certain date in March. So, or after a certain date in March, excuse me, but not before. So it has to be fallen angels lately. So the corporate bond portfolio is probably the safest. LQD, investment grade corporate bonds, iShares. LQD is probably the safest. Angel is second safest. Then the high yield one basically has stock market risk. So I'm trimming HYG right now. So with the bull market intact, we're going to probably get a correction just because everything's getting overbought. There's a couple buy zones on the chart that I showed you, and I'm going to take this presentation and the one I showed you Tuesday and the last one, put them all together into one big report this weekend with the exciting title, Investing in the Second Half of 2020. Right? I wish I could do something more exciting than that, but that's what it is, Investing in the Second Half of 2020. In the bull market intact scenario, we've got the two buy zones with pretty major supports around 288 all the way down to 257. You're going to need to decide on this next correction how involved you want to get back in the stock market and where. Now, I will say that right now the bull market is intact. Clearly it is. It didn't break the trend. It barely hit a 20% correction. And we've had this huge rebound. So if the bull market's intact and you think it will stay intact, then you should get more involved. The two levels I'm looking at are about 278 and about 260 on SPY. And I will just nibble on my favorites and sell a lot of cash secured puts probably. And I will want to have cash secured puts with strike prices that correspond to right around this 260 level to 257 level, which is pretty big support, right? So that I get a net cost basis that corresponds on my stocks and other ETFs to where, you know, to what they should be at if the S&P 500 gets down to around 260. So if I start selling puts between these two numbers, the premium should give me the net cost down here. I hope that's clear for those of you who sell cash secured puts. Thing we have to keep in mind is that if 257 is broken and holds that at the end of a week, then likely something bad is happening if we don't wake up Monday to a much higher market. Meaning that the bull market probably is in fact not going to remain intact. Right? So the second scenario is that we get into just your run-of-the-mill bear market. The only thing that we need for that to happen is a bad second wave of coronavirus that damages the economy again. That's all it'll take. The correlation between COVID-19 optimism and the stock market is pretty much indisputable at this point. Every single piece of data shows that the two are linked. Optimism over a cure and treatments for coronavirus are leading this stock market, along with the Federal Reserve money that is running out. So with Federal Reserve money running out, we rely on coronavirus not hurting the economy again. If the S&P 500 falls below 257-ish, the next lower support zones are at about 241, 215, and 208. 241 would represent not quite setting a new low, and 215 and 208, what was the low, 221? One of these numbers is a new low. I think they both are. I'd have to double check. Now, below these numbers, we start to get into Armageddon territory. What could cause Armageddon? 3 factors. Is there a bad second wave of coronavirus, right? That's the first one for the bear market. Is the federal government slow to react? And does Fed policy start to become ineffectual? And you could put those into separate things, but I think one or the other would be good enough to avoid Armageddon. And with federal government policy, if it were to come to pass, Fed policy would start to become pretty effective as well. So I think they're tied at the hip. And the third thing, the thing that I really think could cause the Armageddon scenario on top of those other two, which are both dangers, right? We know this is a danger, and we know this is a danger, although they've been very helpful so far. The other thing is, does a trade war and or coronavirus damage the supply chains to the point where we see scarcity and a rise in inflation while the economy is constrained, resulting in stagflation? I think this is a very real worry for the second half of this year. So I am very worried about this scenario. I think that the likelihood of the bull market staying intact is around 20%. I think the probability of the Armageddon scenario playing out is around 20%. And I think that this scenario is probably about 60%. So right in here is something that we might see. I think it's more likely than not. Now, the difference between 241 and 208 is pretty big, right? You know, that's 15%. So I would become a pretty big buyer in here if I didn't see this. This third one is the one that I think would scare the hell out of me. So just to go here for a second, I worry that the Fed is putting free markets at risk. I really do. I think that we are seeing the biggest manipulation of assets that we've ever seen in history, even worse than before. I don't think that we're stimulating growth. I think the fact that GDP is still going down, but debt is going up, just puts an exclamation point on the last 11 years in which we've generated more debt than we have growth. We have had a net negative economy for 11 years. And this all goes back to the slow growth forever scenario, the slow growth forever economy that I've described that is structurally challenged, that we will not break out of until either A, a lot of baby boomers die, or B, we wake up and we rebuild the world, from water infrastructure to road infrastructure to communications infrastructure, and then all the things that come with that. When we finally do that, hopefully it's not because we're in a depression. Hopefully it happens next year. So one other thing I'd like to talk about is gold and gold stocks approaching the buy zones again. I've already put up the gold chart. My guess is this is going to beat up today. Is it? Somebody could tell me. I don't know if this is going down today. I would really love to own gold somewhere under 1150-ish. Excuse me, $1,450-ish an ounce. So 142-ish on GLD. This is a big support area. 2 long-term support zones. When we draw other support levels, and you get the confluence, right? You get multiple lines on top of each other. That's usually a good indicator. So this has been climbing a wall of worry with gold. Get to that point where it either needed to break out or retrace. And we're seeing the retrace. This one here, about 151 on gold, 151 on GLD. That's an interesting level where I think you really could start selling cash secured puts. So sell maybe, when it gets to 151, which I think is going to happen. And I don't know if it'll go all the way to 142, but if you started selling cash secured puts here, they gave you a net cost basis here, that would be, I think, a pretty good trade. I'm going to have to pull up GDX for you. So GDX, wow. So it's right at the yellow line. So I think you can start selling puts on GDX right now. You're trying to get a net cost basis of around 24. So we're gonna have to take a look at how we can pull that off. But I think this is a trade I'm gonna go right in and take a look at after this. I think, after we're done here in about 1 minute, I will actually pull up my trading system and we'll take a look at it together. But I think that if you can sell a put nowish, or maybe here, right? Maybe it gets into the upper 20s, gives you a little bit more lower prices and more VIX, right? More volatility. But if you can somehow get a net cost on GDX around 24, I think you are doing awesome. Why? It all goes back to the whole big bull market in gold that we're going to have in the 2020s, right? And there's a lot of reasons why we're going to have a bull market in gold. It's not just all the money printing and devaluation. It's the fact that the industry is very lean right now, and there haven't really been any big new discoveries in the last 15 years. I mean, there's been several, but we're starting to get to the point in the next 10-ish years, 20-ish years, where gold, just to get out of the ground, because we're going to have to find it in different places, is going to become more expensive. So the price of gold will go up. But right now we're in that sweet spot where the price of gold, because the deposits exist, the gold miners can make a bunch of money on rising price of gold because their costs are staying relatively flat. Once the cost of mining starts to go up, then the equation flips and gold becomes a better investment than the gold miner stocks. So I'm still very heavy in the gold miners versus gold, but at some point that equation flips because the cost of getting the gold out of the ground goes up, the company's margins go down, but the price of gold is still going up. Make sense? All right. So that's all I have for today. I will get this posted later today, probably tonight. And I will have a super reports available next week. And if you aren't subscribed to any of my services, here's my sales pitch. I have a bunch of reports coming out this month. I have the peak oil plateau update, which is mostly done. I have 3 reports combining into one for investing in the second half of 2020. I'll probably update the investing in the 2020s report sometime after the 4th of July. And because it's been requested that I streamline some things just to make it easier for folks who don't want to read everything, because we put out a ton of content, ton of research. Dave Zanoni does a great job. Dividend Sleuth has picked it up lately. You know, he had some issues to deal with over the winter. If you're a retiree and you're not reading Dividend Sleuth's pieces, you're missing out. You should be reading some of the stuff that Dividend Sleuth puts up for us ahead of the crowd. So I invite you to come and look at that. And I'm going to put up a 20 stock portfolio for those of you who want long-term sustainable growth. And I'm going to put up a 30 stock portfolio that will update these every quarter for dividend investors, for retiree dividend investors. The dividend investing is tough because certain people are more conservative, certain people are more aggressive. So I'll just split it up into 2 groups of 15 stocks. And if you're the conservative type, munch off the 15. If you're the aggressive, dividend growth type, go to the other 15. Maybe I'll even do 2 groups of 20, right? One that's more conservative and one that's more assertive. That would probably be the easier way to go. So I'm going to break these down into sort of best of model portfolio outline ideas with buy zones, with the charts included. So the links to the charts on TradingView included. So you can see with every stock that we do going forward, we'll have these buy zones to show you where, you can probably buy. We'll have 2 or 3 of these buy zones for every stock. All right. So if you become a new member now, I've just started upgrading fundamental trends. Yeah, there we go. Services. So you don't even need a coupon code anymore. Your first year is half price at fundamental trends, whichever service you want to use, and then we'll earn your renewal. So free library card, risk-free sign up. I encourage you to do the free library card. It is, I think, one of the best free newsletter contents pieces that you can get out there. It includes our special reports, archived analysis, so you can back check us, a monthly piece of members only research. I'll give you something for free, and then the quarterly outlook and game plan I'll also include. So sign up for the free library card if you don't have it. If you're a member, you don't need to do that. It actually screws up your renewal. So don't have a free library card if you're already a member. You get everything anyway. All right, I'll let you go. Enjoy the weekend. Evidence is that you can go outside and hang around with people. Just don't sneeze on each other or cough on each other, and you'll be okay. Tight, confined places, still a problem. Still a problem until we have a vaccine. All right, give me 1 minute and I'll fire up the trading system.